The consumer price index in Korea rose 3.6% in January, recording an increase of 3% for the fourth straight month. The consumer price inflation rate rose to the 3% range for the first time in 9 years and 8 months in October 2021, followed by November and December, followed by a high inflation of 3% for 4 consecutive months until January. Continued food and gas prices soared, and agricultural and livestock products, utility bills, and rental deposit money rose all at once. The stock of FAANG, big tech in the US stock market, is losing its shine. FAANG is an acronym from the acronyms of 5 big tech companies: Facebook, Apple, Amazon, Netflix, and Google. In Korea, it is known as Pang stock. Some investors question whether Netflix is right for FAANG. Some call it FAAMG with Microsoft instead of Netflix. FAANG stocks have risen all at once over the past 3 years, but have all fallen this year. In particular, Netflix and Meta are down more than 38% from their highs. On the other hand, Apple, Amazon, and Alphabet outperformed the market. The Bank Plus index of the New York Stock Exchange fell 10% this year, a bigger drop than the S&P 500 index, which fell 6.2% during the same period. The index consists of 10 technology stocks, including 5 FAANG companies. The steep rise in U.S. Treasury yields hit tech stocks. U.S. Treasury yields rose to their highest level since 2019 on expectations of a rate hike by the U.S. Federal Reserve. When the market interest rate of U.S. Treasury yields, a safer asset, rises, the attractiveness of stocks, a risky asset, decreases relatively. Tech stocks in particular have high expectations of making more money in the future than they are now. It receives high valuation with the expectation that it will generate more future cash flows than immediate profits. When future cash flows are converted to present values, if the market interest rate is high, the present value of the company decreases, so the news of rising interest rate is bad for tech stocks. In addition to rising treasury yields, concerns are growing that the base rate may be raised sooner. Interest rate hikes are bad for growth stocks that reflect expectations for the distant future are negatively affected by higher discount rates when interest rates rise. However, in order to accurately understand the current market, it is necessary to understand the changing value of cash as well. By calculating the price-earnings ratio of cash, you can see how money moves occurs depending on interest rate. PE is the share price divided by earnings per share. Growth stocks with low earnings per share have relatively high PEs. The reason that investment has been focused on growth stocks after COVID-19 is because the PE of cash has soared. An increase in the PE of cash means a decrease in its value. The Bank of Korea's base interest rate fell from 1.25% a year before COVID-19 to 0.50% a year. As a result, the cash flow from 80x also increased to 200x. Investors charge it is more advantageous to invest in growth stocks with a PE of 50 to 100 times than to have cash with a PE of 200 times. This is the background for growth stocks running past until the first half of last year. Since the end of last year, the PE of cash has been falling sharply as the base rate hike started in earnest. Through 3 times, the base interest rate has risen to 1.25% per annum, the level before COVID-19. This means that the cash flow of 200x has fallen to 80x in half a year.